All right, everybody, let's talk about taxes. So 2020 has been a crazy year. If you are, depending on where you are in your business, lots of things could have happened this year for you. You could have made a ton of money. You could have lost some money. You could have broken even. You'd be all over the place. But at the end of the year, every year, I kind of think the tax strategy starts on January 1st, if not before, right, for the year. But at the end of the year, there's some things that you can do and think about to help you make the best. Now that you know what you've made, you've known what the year has looked like, you can make some very strategic moves towards the end of the year. I jotted down a couple of notes and some things that I've done for you to think about. And I'm not going to talk in detail about what I'm doing, but these are some ideas and some things that you could think about in your business and your life. Everybody's individual situation is different. So I highly encourage you talk to a CPA, talk to an attorney, estate planner, whatever it is that you need to talk to in your particular like your situation, to go do that. But here's a couple of ideas and some things that a lot of our members inside of our mastermind group are doing, using, and thinking about this time of year. So one thing for me that I like to do every year is I like to put money into my 401k, my retirement plan. So I fund, you guys have probably heard my friend Tom Lonnie on here talking about the infinite banking concept, this life insurance policies that I have. So I fund that. I fund my Roth IRA. So if you make too much money to fund a Roth IRA, or you think that you do, there's something called a backdoor Roth IRA that a lot of high net worth people do. And basically it's just putting money into a traditional IRA. It's not using after-tax money to fill up your traditional IRA and then converting it to Roth. And so I do a backdoor Roth IRA for myself and my wife. And then I also have a employer plan, 401k plan for my company. So before I had any employees, I used a solo 401k. Now I have a safe harbor 401k since I have some W-2 employees. And I'm allowed to put money into my 401k. So I fill up my Roth, and then I do a pre-tax like bonus from the company. So the company match that I have. So the company matches money, and that's a tax deduction. So it's pre-tax money that goes into my traditional 401k plan. So I can do that. That's one thing that I do to reduce my taxable burden. So that's a write-off on the taxes. And I like filling up the 401k. So I do IRA, I do my life insurance policy, then I do my 401k. And I believe, don't quote me on this, but 2020, I think is $58,000 max per person for a solo 401k SEP IRA type structure, or a safe harbor like I have. So that's one thing that I do. And I really like that. The other thing is the HSA. So a health savings account is another tax benefit that you could have if you have a high deductible insurance plan. So an HSA is another thing you might want to look into. And you can self-direct these accounts. So I have all mine self-directed. I do loans. I invest in multifamily buildings. I do all kinds of stuff inside my IRAs and 401ks. I don't have an HSA because I'm still in the military, and I have TRICARE. It's a low deductible plan, but if you have a high deductible plan, you could look into an HSA. Some pretty cool stuff you can do with that. The other thing that could have happened to you this year, and hopefully you took advantage of it, was some capital loss harvesting potentially if you're invested in the stock market. So when you have some losses in the stock market, what you can do is you can actually sell your stock at a loss and then go buy something that's kind of comparable but not the same, right? And go buy it, and then it could go up. So this, I don't know, stock market was down around 18,000 at some point, and it's over 30,000 now. So as you see your stocks going up and down, you can basically capital loss harvest or capital gain harvest potentially, depending on what you want to do for your stocks. So something to think about. You might just want to Google capital loss harvesting and look into that. So there's a couple different things that you can find similar but not exact index funds, things like that a lot of people use when their stocks go down significantly. You can take that capital loss, put it on the books, and then go buy something else around that same price that can then go up in the future. So that's something that I've done in the past a lot of when I was investing in the stock market. So if any of you are still in the stock market, capital loss harvesting is something you can think about. The Section 179 deduction is one that I really like and you should look into. It's basically about buying some heavy equipment and machinery for your business. So think airplanes, vehicles, construction equipment, stuff like that. And you could do a bonus depreciation where you can depreciate 100% of this in year one. So if you put it into service, so you still have time in December to go buy something, and you could, let's say you buy a big heavy truck, right? An F-350 or something for your business. And you put it into service on December 31st and you use it 100% for business. That day of December 31st is in service. Then for 2020, you can write off 100% of that potentially under the Section 179 deduction for your business. So you can take it and not only you don't have to pay cash for this either. That's a really cool thing. So I always thought I had to pay cash for this stuff, but you can finance it. You can finance 100% of that vehicle and write it off and get a major deduction on your taxes under 179. So take a look into that, Section 179 deduction. I did a YouTube video on it earlier this year. You can go to YouTube, our 7-Figure Flipping YouTube channel, and check out our Section 179 deduction video. I go into a lot more detail on that. I've done some Sections 179 deductions on my taxes. I have an airplane that I fly around for the business now, and I absolutely love flying the airplane, but I was able to depreciate it. And then as I fix up the avionics and do paint and make repairs and do different things to it, it's a business write-off for me. So the other thing is opportunity zones. So opportunity zones is another area you might want to look into if you're buying and holding residential real estate or commercial real estate in an opportunity zone. There's a lot of things that you can do with that. It might be a little bit too late to set up an opportunity zone fund this year, but something to think about, look into, and see if your area is in an opportunity zone. I'm not going to go into too many details, but that is a good thing to look at and think about. The other thing that you can do is a cost segregation study. So I mentioned bonus depreciation. If you have rental property or you have commercial real estate, there's the opportunity to do a cost segregation study. And even a single family home, you're probably depreciating it year over year, right? And if you're not, you should be, because whether you depreciate it or not, the IRS looks at it like it should have been depreciated. So always, 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 you have to depreciate your real estate, okay? So with a commercial building or a rental property, you're able to do a cost segregation study on this and then do bonus depreciation where you can actually depreciate that piece of real estate in year one instead of over 27 and a half years, or depending on what it is, there's different timelines and structures for each of these items inside the property. So this is massive for us, and really what has allowed me to reduce my taxable income the past couple of years. And I started buying commercial real estate, apartments, things like that, and being involved in syndications, getting Schedule Cs with major losses on them because we did bonus depreciation in year one. So big write-offs for me to allow me to reduce my active income. And the reason I'm allowed to reduce my active income is because I'm a real estate professional. So take a look at qualifying for a real estate professional. If you work a full-time job and you're just a part-time real estate investor, one strategy is if you're married and your spouse stays at home, then consider trying to have your spouse become a real estate professional. If you're a full-time real estate investor, you really don't have a problem qualifying as a real estate professional. Just talk to your CPA, tell them, I want to figure out how to qualify as a real estate professional. That way you can take all this depreciation that we're talking about, all these write-offs, all these different things, and offset your active income. And that's the key. If you make $300,000, $400,000 active income, but you have $500,000 in losses, next thing you know, you're writing off a $100,000 loss in that year for taxes. And so that brings me to my next point. So cost segregation studies, bonus depreciation, big write-offs on your taxes. One recommendation I have for you is for single family homes is a company called KBKG. So I think it's kbkg.com. You can go there and they have a software tool that you can use. Just check with your CPA and make sure that they're willing to sign your return using that as your cost segregation study. You basically input some information about it. It's like $500 or $600 per property as opposed to thousands of dollars, tens of thousands of dollars for larger commercial buildings. And it's one way to go for your cost segs for your single family rentals. If you bought 15 single family rentals this year, and you can do individual cost segregations on each of them, do bonus depreciation in year one, you can have massive write-offs this year to reduce your active income if you're a real estate professional. So from that, so let's use that example that I had. I had a $400,000 of active income. I wrote off $500,000 on Schedule Cs because of bonus depreciation and all the other things that I had going on, right? So I have this $100,000 in loss. So then one thing that I can do, which is really cool, is let's say I put all that money into my traditional 401k, right? And that I talked about, all that company match in that 401k. Maybe it's $36,000, $37,000. Well, I can take that and convert that from traditional to Roth. And that's a taxable event, right? So it was a tax write-off. That $37,000 that went in there is a tax write-off. But my conversion now would be at my tax bracket. Well, if I have a $100,000 loss and I converted $37,000 from my traditional to my Roth, my taxes on that are going to be zero. So it's basically a free conversion from traditional to Roth that I can then grow for the next 30 years, 40 years, however old you are, however long you're going to grow that inside of your IRA or 401k. tax-free because it's moved over to a Roth. So that's the structure of basically converting retirement plans when you have some losses, or looking at your tax bracket and strategically converting that money. I've been doing that for the past couple of years, converting my traditional 401k money over into Roth 401k money, and basically getting the tax write-off a few years ago and now converting it because I am in a low tax bracket because I have large write-offs for depreciation. So hopefully that helps and triggers a couple things for you. And by all means, play this for your CPA or whoever you're working with and give them some ideas. And maybe they say that you can't do that in your situation, but start thinking about this and strategically planning for it, especially at the end of the year. The other thing is taking a look at like moving around some income. So if you're in a high tax bracket, so you're the big breadwinner of your family, you might have some other people in the family that could work for your business. So if you're a business owner, your spouse could do some marketing or could do some admin work, and they might be your spouse is going to be in your same tax bracket because you're probably married filing jointly. But what about your kids? Your kids are in a low tax bracket. Maybe they're under 18. And they can get paid $5,000, $10,000, $15,000 to do some things for the business. Maybe they're doing admin work. Maybe they're taking pictures. Maybe they're sweeping out houses. Maybe they're painting. Maybe they're doing landscaping. Maybe they're doing some marketing. Maybe they're models for your business. There's all kinds of things that they could be doing for your company. And you could basically pay them $10,000 as an example towards their business. They're in a tax bracket of 0, right? So their taxable liability on that money is very low. And then that's a write-off for your business. That $10,000 comes off of your income as the business owner and the company that's making money, and moving over and shifting to somebody who's in a lower tax bracket. And you can shift some of that income if they're legitimately doing work for your business, right? They have to legitimately be doing things in order for you to pay them. Dot your I's, cross your T's, have a contract with them, have an employment agreement, put them on payroll. They should be W-2 employees, all those things. And then if they get paid W-2 employee income, then they can create a Roth IRA and they can start contributing to their Roth IRA. Even as like little kids can have a Roth IRA as long as they have W-2 income. I remember as I was growing up, I was at a W-2 job and my dad would always push me to put money into my Roth IRA. The maximum was $2,000 a year at that time. It's crazy to think that. It's at $6,000 now. So $2,000 I could put in my Roth IRA, and he would really push me to do that as I was getting W-2 jobs as I was getting a little bit older. So something you can do and start thinking about your kids and their retirement plans, start teaching them about money too. So let's see, what else? The last thing that I really want to talk about is being smart about how you spend money towards the end of the year. So there's a lot of sales going on right now, Christmas sales. We just had like Thanksgiving, Black Friday sales and all that stuff, Cyber Monday. And start thinking about what you need for your business. And maybe you need it in January and February, but it's ideal to spend it in December. So maybe it's a computer, maybe it's some upgraded monitors, maybe it's some lighting, maybe it's camera equipment, maybe it's some equipment for your business. Maybe it's a saw or things like that can become assets to your business that you can eventually depreciate and write off potentially. So think about that. Spend that expense in 2020, because what you're going to do is now when you write that off in 2020 instead of January 1st, 2021, you can move and shift your expenses into the previous year. And so that's going to give you deductions. You're going to spend the money anyway a month from now. And what it will do is it'll shift all of that to 2020. So you'll see that benefit in potentially April 2021, as opposed to April 2022. So if you spent that money on January 1st, 2021, you wouldn't see that deduction for over a year, about 15 months, if you filed on time. And I guarantee most of you don't. So you might be a year and a half or more before you see the benefit of that. So think about some of that stuff. How can you shift some of your expenses? What we used to do is we used to take the marketing costs, so all the marketing costs that we were going to spend in January 2021, and we would spend it at the end of December and get a credit with our mail house, so that we can like basically supercharge our expenses in the previous tax year, get that deduction right away, because we're going to spend the money anyway in the next few months. So why not call up your mail house, call up some other vendors and say, hey, can I buy credit with you for maybe the next quarter, and spend the marketing money now, get the write-off, reduce your taxable burden, and then next year, when you move into January, you can see bigger profits and not have to pay taxes on that money for over a year. So some other things to think about. I always look at that, like, how do I increase my expenditures? But I don't go out and buy things that you wouldn't normally buy. So if you're not going to buy a computer, you're not going to buy monitors, you're not going to buy cameras, and you're just trying to get a write-off, please don't do that. Don't go buy a car or a big truck or an airplane or anything like that. If you're just looking for a deduction, you're still spending money to get the deductions, okay? So that's one thing. The other thing that you can do is if you've got training courses or events that you're going to plan for 2021 and you got to buy plane tickets and hotel rooms and stuff like that and spend money, then go spend that money in December instead of January. Maybe it's like our mastermind members are on a payment plan, a monthly payment plan. So what I would do is I would pay all of that right up front. I would pay it in December of 2020, and then I would get the benefit right now of that write-off. And instead of waiting and paying like monthly and paying more money. So one thing for mastermind members, you can go pay in full. You can pay for a course, a training. You can go to 500kchallenge.com and grab our $100 course and write it off this year in December. So there's lots of things that you can do to spend some of the money that you would in the future in December. But again, only spend that money if you were going to spend it anyway. So if you're a mastermind member, you're committed to pay, and on the payment plan, it costs more, right? So why not lock that in right now in December, and you can actually write that off now and get the benefit by April 15th, 2021, instead of April 2022. So think about some of that stuff. Like, where are you spending your money? Really take stock in it. Sit down over these next couple of weeks before the end of the year and strategically look at your books, look at your P&Ls, look at your balance sheets, figure out where you are and where you're potentially going to end up. Hopefully you're working with your CPA and you're coming up with strategic plans of where you are and where you're going to land, and then you can make some moves here towards the end of the year. There are some things that you can fund all the way up to April 15th that will count for 2020. It's not going to be expenses, but it could be some retirement accounts and things like that. But ultimately, by December 31st, that clock strikes and that's it. January 1st, the expenses and expenditures that you're doing are going into 2021's tax year. So I try to do this podcast every year. I try to talk about this. We did a deep, deep dive in our 7-figure altitude. I mean, 2 hours of talking about this. I shared all of my strategies, exactly how I'm doing it, how they could potentially do it. Some big ones are bonus depreciation in some of the cost segregation studies of like large apartment buildings that I'm involved in. So I'd recommend you get involved in some of that stuff. Section 179, the income shifting from you to your kids potentially, 401ks and matching, and then expenses, like supercharging your expenses in December is a great option. You're going to spend it anyway in January. Get some depreciable assets, spend some marketing money, any other contractors that you're working with that you know you're going to continue to work with, stuff like that. Can you pay upfront? Maybe it's Home Depot, Lowe's, things like that. Get some credits, lots of different things that you could do there. Paying off your mastermind events, courses, trainings, booking flights, stuff like that, and spending money. So hopefully those are some good tips. One other thing that I have is, if you guys aren't spending money on a credit card and being smart about it, paying it off every month, that has some cash back and cash rewards items involved in it, you should. I mean, I'm getting $15,000 to $20,000 checks per year for the amount of money that we spend on our credit cards with cash back. So I'll get a check in like February or March, and it'll be $10,000, $15,000, something like that, which is the cash back from the credit card. So think about that. Obviously, it's merchants like me and other companies that are paying, 2.5%, 3%, and you're getting 2% cash back. But take advantage of it. Definitely use it. So hopefully this helps. If you want to be involved in our $1 million calls, all these things that we're doing inside the mastermind group, just go to 7figurealtitude.com. So the number 7figurealtitude.com, submit an application, talk to us, see if it's the right fit for you. Again, we only take people that are doing about 10 or more deals a year, $200,000 or more in profit. You guys already have a systemized business, and we can just help you grow and scale to that next level, add some team members, grow your team, get out of the day-to-day and help you, and just be a community and resource for you. Have an amazing community of people. It's curated. We only let certain people in. Like, it has to be the right fit for us and the right fit for you. So go to 7figurealtitude.com, check that out. And I appreciate you listening to the podcast. Hopefully this quick one helped. It's all taxes right now. It's the thing that I'm focused on the most. And hopefully it helps you move forward into out of 2020 into 2021. So we've got some incredible podcasts to end the year coming up. So stick with us, and I can't wait to share my year in review, what my plans are for 2021, and I got a couple cool announcements that we have brewing right now. So go to 7figurealtitude.com, jump in, submit an application. If you want to write off, go to 500kchallenge.com, spend $100, get a write off for 2020, jump into the challenge, raise some money. And one more thing before I go. The other thing that you could do is if you have investors and lenders that are on an annual note and they're renewing their note, but they don't want to get their interest paid, you can do a paper conversion. So let's say you had a $100,000 investor, they have $12,000 of interest in 2020. You can renew their note for $112,000. So they made 12% interest, $12,000, $112,000. That's a $12,000 payment on a new note that you can write off and roll into the next year. So it could be a deduction that you can have on your business too. So it's a little tricky secret that I have that I like to use. If my investors are not cashing out and not wanting to get their interest paid, I can roll it into the next year by renewing the note and make a paper transaction. So hopefully that helps. I'll see you guys on the next podcast. That's a little bonus for you.